So we've seen FX in emerging markets under pressure. What are some of the trends, though, that we've seen from emerging market central banks so far this year?
Well, if developed markets behave themselves, emerging markets would be in much less trouble than they are now. But, there are idiosyncratic risks in emerging markets which are driving each currency, each national market assets in different directions. And there are external shocks all coming together. If you look at the group dynamics as emerging markets, the picture is benign. Inflation is low and reserves are high and debt is low and so on. But if you look at individual markets, there is a completely different story. Several nations are fighting high persistent inflation, the political uncertainty, and even the stronger economies like India are suffering now. So it's pretty brutal at this moment. And we'll have to see how it pans out.
Yeah, and one country that certainly has been suffering with its economy, Argentina. I've got a chart here showing double-digit declines, the peso century bond and stock index sliding in 2018. Have higher rates exacerbated the economy's woes?
Yes, absolutely, because they are facing a huge dilemma. For several years, there has been a dichotomy between the fiscal policy and the monetary policy, and that's created a macro imbalance. And now they have agreed with IMF to cut inflation by about 10 percentage points. And that means aligning fiscal policy with monetary policy and being really hawkish about it. And that's going to tell on the economy. So I think that a recessionary Argentina is almost a given. But then, one thing to say about Argentina is that it's a country that promises to give you an average yield of 9.5% for the next 99 years. And if you believe that the country will honor its commitment, will pay its coupons, then that's your pension pot, 9.5%, moving on 10%
it's
now.
It's a long time off, though, isn't it? 99
yes,
years. There's a big
some investors will be interested in this, and they will, allot a small portion of the portfolio for that risk. But the economy itself is really shaky.
So Scott, the emerging markets for you then, from your perspective, we talk about some of the idiosyncratic risks, but the asset class as a whole. I was reading a Macro Man blogger just yesterday was talking about, and this may be more on the stock side, but saying it looks as if it's too late to sell EM and too early to buy. From a bond perspective, where do you stand on EM?
Well, I think, first of all, to come back to the fundamentals, I think is important. So what we've had countries that have a lot of external borrowing requirements, so borrow in U.S. dollars. And then we've had economies that have big current account deficits. So Turkey being one of those, South Africa, Argentina. Those are the ones that have really, Mexico in some respects, those have really suffered from this kind of vulnerability, if you will, and that's really been a factor of higher U.S. rates and a stronger U.S. dollar. So the backdrop, I think, in general has been negative for emerging markets in the sense that the policy of rate hikes and the strength of the dollar has impacted these countries with these external vulnerabilities. Yeah. Except going forward, as we talked about earlier, I do believe a lot of the trade war issues concerns are being priced into emerging markets. So you have this combination of kind of fundamentals, idiosyncratic issues, political, otherwise, in particular countries, plus these vulnerabilities, make it an underperforming asset class. We've had about a 6% fall in both the hard currency and in the local markets. Yeah. But what I would suggest that particularly in the hard currency markets, where you now have a spread that's really greater than high yield in some respects, depending on what part of the high yield you have, 3.5% to 4% higher yield for emerging market currencies or countries than you have for treasuries, that starts to look attractive to us. I mean, that's an interesting asset class at this level.
And to that point, this is a chart I've got just about what you were saying, showing that developing economy, the premium at April 2016 levels, you've just been pointing to being compensated for risk there. Yeah. Would you say that you're compensated for risk across the spectrum, or would you still be very selective at where you look in emerging markets?
Yeah, I think you need to be a little bit selective, because what's happened is that, as was mentioned earlier, some of the countries with the higher vulnerabilities have really underperformed, where some other countries have not. And so really for emerging market investors, this would be the time, in my view, to look at some of the what we call higher beta countries. So those countries where there's certainly a certain amount of risk, but where there's been a dramatic repricing. So again, countries like Turkey, Argentina, Mexico, where you have this fundamental repricing, but then there's this added layer around, let's say, Mexico NAFTA, for example. So I think there's a lot of tremendous opportunity in emerging markets as we stand.